The ideal times to accumulate wealth are during recessions, and it appears that the current scenario is turning into a once-in-a-lifetime chance to greatly increase your wealth, because the wealthy typically prosper during difficult times. There's a proverb that goes, "Wealth is made in recession." And if you consider the state of the economy today, it is clear that a comparable opportunity is knocking once more. But keep in mind that opportunities don't endure indefinitely. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. Check out these most recent headlines. You'll discover that 90% of CEOs are getting ready for a downturn, while JP Morgan warns the stock market could decline another 20% from its current levels. All CFOs are reducing costs by 10%. Recessions do occur from time to time, despite the fact that it seems dismal and depressing. If we make the most of the situation, we can be set up to take advantage of amazing opportunities and deals for the rest of our life. The venerable Warren Buffett once said that an investor's best friend is bad news. What is anticipated to occur during the next 12 to 24 months is listed below. Recessions typically result in a sharp increase in unemployment, a collapse in earnings, a loss of consumer confidence, and a drop in the value of nearly everything, including stocks, energy, food, and services, with some impacts persisting for a while globally. Second, a recession lowers corporate profits. Recently reported, quarterly earnings show slow or negative growth. Layoffs occur on a larger scale as a result of the reduced work and tight incomes. A drastic fall in aggregate demand results from the cumulative impact. And it's clear that a huge number of businesses have been letting employees go. According to the Bank of America, the United States will lose 170,000 jobs on average each month. What does all of this mean for your investment, and how can you use this knowledge to your advantage? Stocks will be our first topic. Year to date, all three of the major indices have decreased by up to 30%. JP Morgan study predicts that these will lose another 20% of their current value. We may infer from historical data going back to 1946 that the greatest bearish numbers were 30%. The S&P plummeted 57% from its peak in the fall of 2009, which was the most extreme. When the recession is factored in, these bear markets reach a level of 34.8% on average, and currently, the market is down about 25%. We know we have reached the bottom when we observe investors pulling back everywhere. Exactly at this point, things begin to recover slowly and bounce back. Let's discuss real estate now. Each community has its own unique characteristics, and some may continue to have thriving housing markets. However, countrywide reductions are incredibly uncommon to be observed. There have been very few occasions in the past 60 years when prices have fallen dramatically by more than 10%. The consensus on Wall Street now predicts that national housing prices will drop by 7%, with a worst-case decrease of 10% to 15%. If interest rates keep rising, different market reactions are possible. Markets that are most susceptible can experience a 25% drop from their high. This applies to regions of Idaho, Florida, Arizona, and Southern California, where the decline typically lasts for about a year and a half before bottoming out. For those with fixed mortgages, who intend to stay in their homes for the next 5 to 10 years, this won't make a significant difference. However, if someone wants to invest in real estate, we should anticipate seeing specific agreements. The third factor is money. Cash is typically thought as nothing more than a waste product of inflation. Cash, however, may always be the safest place to hold capital when asset prices are declining. The statement gains significance when a billionaire concurs that money is no longer considered trash. People may have forgotten, but in 2018, cash was the asset that performed the best. You would have outperformed the market if you had been saving your money in high-yield savings accounts. Without a doubt, cash is quickly rising to the top of a portfolio's importance list. The quantity of cash held by fund managers is at its highest level since 2001. What can you do in light of all of this to earn money? And why do people typically miss opportunities to benefit from what lies ahead? What you need to know is as follows. The first factor that makes a recession A once-in-a-generation chance to increase wealth is that everything will be more affordable. A wealthy individual would sense an opportunity to purchase everything at a 30% discount. When a person thinks that this is not the best time to invest and everything is falling by roughly 30%. Except for stocks, people have the same thoughts about everything in life. Even though one can gain more for their money when equities decline, no one wants them anymore. Therefore, you need to change your perspective and realize that even a declining market might work in your favor. Less competition is the second factor. In tough circumstances, businesses cut back on spending to protect their finances. On the other side, it creates opportunities for more competitive, smaller businesses to step up and take their place. A study of 16,000 businesses found that those who continued promoting towards the end of recession increased their wealth and became larger. More opportunities are the third. The market is using the recession to purge the weak players and create growth possibilities for new, smaller enterprises and individuals. Any market's apex is similar to a forest where only the tallest trees receive sunlight. This means that, as in our markets, only established businesses have access to resources. However, just like a forest on fire, our economies have a way of bankrupting the giants that can no longer support themselves and providing opportunities for those smaller firms to continue to grow and prosper. The fourth is that a bull market always follows a bear market. According to Yahoo, the S&P 500 has often dropped by 29% during recessions. However, the stock that hit its lowest price return at 40% the following year and at 58% after a few years. This means that staying in during a downturn would be more profitable than leaving. History shows that waiting for long-term markets to recover always works. Fifth, you must take action before anyone else is aware. It's easier said than done. Although investing during recession sounds acceptable, they are never confirmed. How you'll make up the difference, and whether you can possibly take preventive action before all of this occurs. Second, you should keep some cash on hand. While it is true that investing money yields the best returns, having cash on hand will give you greater security. Depending on the season, an investor always keeps 15 to 20% of his or her portfolio in cash. Investors can now seize advantageous opportunities thanks to this. Third, you need to safeguard your career. Whichever way things turn out, this will prove to be your best hedge. The worst case scenario is not that the market declines, but rather the market declines and you lose your job simultaneously. The investment will therefore lose value before it has a chance to recover. The best time to pick up new abilities and improve what you already know is right now. For instance, a portfolio's return during 2014 may have increased by 65% with a 5% allocation of Bitcoin. Fourth, concentrate only on long-term investing. It's generally best to avoid investing any money that you will need within the next 5 years. The best way to invest is to continue doing the same way as always. One of the most successful long-term investment strategies is dollar cost averaging, which involves buying at regular intervals. So continue to buy and stay in the market. Fifth, spread out your investing portfolio. If you can't handle a 20% price decrease, well, chances are you've made aggressive investments. For instance, if you bought in American technology stocks, you should consider investing in real estate instead, as the rents there appear to be more reliable. Your portfolio will have greater stability this way and be less prone to lose value. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.